I think at least part of my panel was climate constrained. That's a new word I'm going to come up with in attending today. So I am the only live person in this panel. The other three participants in my panel are on the screen, as you can see, Katharine, Paul, and Travis. Thank you all for at least making it by Zoom. So we appreciate that. We could hear each of their stories as to forest fires, weather, climate patterns, whatever that might be. I'll just start off this panel by saying that I'm trying to replace ESG as an acronym with AIR, A-I-R. AIR standing for adaptation, innovation, and regulation, being the three levers that are going to impact capital markets pricing in the near future. It's something we've been writing about at my firm for the last 4 years. And just as a marketing ploy, it'll be really hard to come up with an anti-AIR campaign from the anti-ESG folks. So I'm just trying to make it really difficult for their marketing people to attack me. But that is the theme for today. And under adaptation, I would include mitigation. Under innovation, I would include investment. And under regulation, I would include litigation. So when you look across the field of what is going to impact capital markets, if you use that framework, it does a really good job at letting you know where you can invest opportunistically around climate and where you're going to see risk in climate. So I'll start with quick introductions. Ladies first. Katharine, if you want to introduce yourself and your climate story of why you couldn't make it here today.
Yeah, sure. And hi, everyone. And for those of you that have been there through the day, you would have seen me at the beginning of this morning as well. So I don't want to repeat myself, but couldn't be with you all after every airport in New York shut last night, and then all those flights from Toronto, then had to try to get there today. And so there were no seats last night or today to land in New York City from Toronto. So very disappointed not to be there in person. So I lead the sustainable investing activities at OMERS, a public sector defined benefit pension plan located in Ontario, and we manage over 125 billion Canadian dollars for our members. That's invested in public and private assets, just over 55% actually in the private asset classes of real estate, infrastructure, and private equity. So I will leave it there to not repeat myself.
Thanks, Travis. You want to go next?
Yeah, good to see everyone today. Travis Antonio, Investment Director of Sustainable Investments over at CalPERS, California's largest pension system. We represent a couple million different members, about $450 billion of assets under management. The Sustainable Investments Group, which I work in, works across the total fund, across all asset classes. We help participate on some of the due diligence of some of the deals across both publics and privates. We also handle a lot of the regulatory aspects, working with our legislative affairs type of group that could be affecting our investment portfolio or the total fund. And then we also work with our communications team and various other type of teams on integrating sustainability and being able to articulate what we're actually doing to our membership group, which carries over into why I wasn't there today. And that's because I'm finishing up some type of slide deck for our July offsite board meeting, which is coming up right around the corner. And that will dive into a teaser of our refresh net zero strategy. So more to come on that.
Excellent. We'll come back to that. And Paul, I think you were on screen recently enough that we don't need an intro. So I was thinking we would just start with questions. I was also thinking this could have been like an AI panel. None of you could be real, and I could have just taken some stolen film. And but Paul, I think we spoke in the prep for this call about, is this an alpha or a beta opportunity, and really how to take advantage from both angles. So maybe you can start off the investment theme with a little discussion on that.
Sure. I mean, as we, I think, discussed this morning, most of the returns of any big global portfolio is going to be beta. So it's going to be driven by economic developments, by what happens globally or whatever economies that you invest in. And we really have no control over that. I think the exciting opportunities in climate and renewable energy are alpha opportunities, because we're going to transform the entire global energy system in the next few decades. That's going to mean a massive switch in terms of the enterprises that produce, transmit, and use energy. The challenge for investors to take advantage of that is the more you want alpha and the less you want beta, the more you have to deviate from the herd. Having just a few percent of your assets directed towards this global climate transition isn't going to make any difference. You have to have 10, 20, 30% of your assets dedicated or directed towards this transition. And that's really hard. It's really hard because it's taking a lot of risk. None of us like to deviate from the herd very much. And it requires you to get your security selection right. So I think it's a real challenge. I think we know what we want to do, but achieving it is pretty hard.
Let's jump to Travis, because you're, certainly running a portfolio and having to at least be involved in that more deeper security selection aspect of it. And how are you guys looking at regulation, the R in AIR, and how that might impact investment themes within the portfolio?
Yeah, so in the past, I did co-manage a $10 billion public equity portfolio, but as of right now, we do not have a dedicated set of capital towards the sustainable investments group. We might in the future, but instead we work thoroughly with each of the different asset classes. Definitely agree with Paul as far as his focus on alpha generation, his focus on alpha being the key theme. I don't think that significant amounts of change will come about by just investing into some type of basic index type of product, which is going to be replicating essentially the holdings that you already have with just some type of minor slight tilt. You're going to be having to take on some type of degree of active risk to be able to generate that alpha and be able to take advantage of the opportunities that are going to present themselves. But where do these opportunities actually lie, and what is going to be the catalyst for those opportunities? And I think that's really going to come from regulation. And specifically, if you look at the investment, the Inflation Reduction Act being one of them, originally targeted for $300+ billion of investments that'll be coming about from this. You're now looking at estimates from Goldman, in excess of $1 trillion. These are staggering amounts of capital, and I can't tell you how many conversations every single week I'm having with different asset managers that are reaching out to and referring to some of the tax credits, referring to some of the benefits that are going to be happening across different sectors. And also the conversations that I'm having, not only internally, but also with many other asset owners to be able to understand where the best positions lie to be able to pursue these opportunities. I think the biggest thing, though, will probably, one of the biggest things that is not getting too far ahead of ourselves, knowing our core competencies or expertise, our own policy limitations, and understanding where those policy limitations need to be relaxed or redefined. And I think that trickles into Paul's points as well, to be able to expand on the active risks that we're actually allowed to take and in specific asset classes. Perhaps that was a little bit vague in certain areas, but I'm happy to dive into details later on in the conversation.
Great, thank you. Katharine, maybe we could talk a little bit about decarbonization. And also, I just want to say, going back to Travis's point about regulation, the ISSB finally came out this week with their standards, which hopefully will give some guidance into what the SEC will come out with in October, it looks like, most likely at this point. We'll see how aligned they are. We know they talk a lot, but we don't know how aligned. And we certainly know that the SEC is feeling pressure to come out with something that won't get wrapped up in lawsuits for the next 2 years in the Senate and the Congress and wind up not going anywhere. So there's a fine balance there. And speaking of balance, what Katharine and I had spoken about previously is kind of what is the benefit of decarbonizing your portfolio and meeting some of these targets with companies that are making commitments versus is that really having an impact on decarbonizing the economy? Maybe you can touch on that, Katharine.
Absolutely. And just want to echo your comment on the ISSB standards coming out this week, and having spent now 2 decades in this industry defining what E, S, and G is and all the different criteria and metrics, and really excited that this will help start to transform the standardization and hopefully reduce the burden on companies to answer all the questionnaires, et cetera, they're getting, and hopefully provide some more context for the next phase of taxonomy, which is maybe something we can get into, and hopefully some innovation around how we define companies within our portfolios, because as Paul says, we need to grow 10, 20, 30% into these lower carbon companies, but it's very difficult to measure that today. So just on the balance piece, as a fiduciary defined benefit, public sector pension plan, always so focused on our fiduciary duty and being focused on ESG and climate and marrying the two, saying, it's incumbent on us due to our duty to take these things into consideration. And we set the net zero 2050 goal. We set interim targets, which are really focused on reducing sort of climate transition risk within the portfolio, but really only the pricing risk of every atom of carbon. And so it's a very limited view. We're all struggling with challenges around how to measure and report progress in this area. But we all know the carbon footprint is such a small view of that larger risk. It's a point in time measurement, it's backward looking, doesn't show where the companies are going. And are we actually de-risking our portfolio if, as we say, climate risk is a systemic beta risk? Just getting rid of it out of our portfolio doesn't mean we're getting rid of it out of the overall long-term returns of the plan. And so what else should we be doing to start talking about the role we need to play in actually decarbonizing the real economy? Yes, we can do that within our portfolio companies. We're fortunate to have a lot of direct investments, so we may have board seats, so we can engage directly with the company as they transition. But on the public side, that does get tougher. There's collaborative initiatives we're part of. But is the other piece of that engaging with regulators and public policy makers, which we do really as far as ESG disclosure standards come in, but how much further can we go in terms of trying to create policy that is more friendly to sustainable finance?
Thank you. Just for those of you that aren't aware, if you go to my website, gittermanasset.com, we have a paper that we published with some of the world's largest asset managers called The Great Repricing in 21, and that paper specifically talks about repricing risk in the capital markets from a bunch of different trends, both from transition risk and physical risk, and it's a free download that's available for anyone that's interested. So back to you, Paul. One of the issues that we've really been focused on at our firm is small-scale nuclear. And I know from the innovation side, maybe you can talk about what you guys are looking at. I don't know if anyone saw the Department of Defense came out about 2 weeks ago and said that they're 6 months away from being able to deliver small-scale nuclear in freight cars, basically in a container car, to climate disaster sites. So the article specifically spoke about the risks that they're concerned about of bringing power quickly to climate disaster sites in the future. And I envision a world where 3 years from now, we've seen nuclear actually save communities, and it changes the social score of how people are looking at nuclear. And we then maybe get pressure on regulation and permitting. Paul, maybe you can take us deeper on that topic.
I think it's a great topic, Jeff, because it's a proven source of carbon-free energy and huge amounts of controversy, but I think leaving nuclear out of the renewable energy solution is just going to be very costly in the long run. One of the most exciting things, I think, and this is, people are talking about it here in Wyoming, we have all these coal plants, which are these big things that burn bad coal and make electricity, but they're already hooked up to the power grid. They're very far typically from where anyone lives, and they're great places to bring in a half dozen small modular nuclear reactors, fire them up and connect them immediately to the grid. So I think there's a lot of very positive solutions, but it's a huge policy problem. I mean, you mentioned the permitting. I think the industry has the technology, and we know technology improves when you use more of it, right? So if you start learning by doing and building these things, the costs and the operability will will improve. But it's hugely controversial in the renewable energy or the green climate world. And I'm not sure, I think that's probably the biggest obstacle, and I'm not quite sure how to get around that.
I mean, it's interesting because you've seen in Europe, they have started moving nuclear to be considered green in the IRA bill, as we now call it. There is provisions for nuclear being considered green, so there's actual investment benefits within the IRA bill. And companies like Panellists recently changed their screening process, and they, are an early ESG adopter for sure, to include nuclear as not a screened investment in their portfolio. Travis, let's shoot over to you for a second, and just thoughts about carbon offsetting and maybe how you guys look at getting to net zero as a portfolio, if that is something that you guys have looked at deeply. Is carbon offsetting effective? Is there ways to do it effectively and ways to not do it effectively? Is this something that the board there is thinking about?
I think this is something that both the organization is thinking about, but at the same time, I think we have to have a little bit of a reality check of what the purpose of carbon offsets truly are, not only today, but then also in the future. If any type of net zero strategy is, significantly reliant on carbon offsets, I would really question the validity of that type of strategy. And pretty much across all sectors, the idea of carbon offsets, it should be segmented only to those residual type of emissions. And I would think that there would be far, far better ways to be able to focus your attention on operational efficiencies, energy efficiency, other type of CapEx, OpEx type of projects that will provide far better returns, not only from an investment perspective, but also from a emissions perspective as well, than focusing on just buying and utilizing carbon offsets. Now, do I think that there's opportunities to make money from carbon offsets through platform companies and also through selling credits? Sure. There's plenty of money that's chasing that, and I'm sure some will win and some or many will lose. I think there's also a great concern about regulatory risk related to this, and it's something that we actually called on the SEC through our climate disclosure SEC comment letter last year on. There needs to be regulatory reform and oversight on these type of carbon markets, because we have seen over the last year, CEOs step down of certain, offsite type of companies. We've seen very concerning type of scientific evidence, really questioning just how much of an impact some of these credits are actually participating on. And at the same time, we've also seen some very, very encouraging type of aspects. I would say that some of the most interesting and encouraging aspects are actually coming more from the tech companies, in the US than probably anywhere else. And those are perhaps those, that are more driven by technological type of carbon offsetting than from nature-based, offsetting, or perhaps beyond even nature-based, very specifically avoidance type of credits, which I think most people have the greatest concern on. And I will also say that related to this carbon offsets, I'm encouraged to see the greenhouse gas protocol looking into renewable energy credits. This is something that I mentioned in our previous comment letter, and I mentioned to many of the banks that I've spoke to, as probably the largest mischaracterization of Scope 2 emissions. And it's something that hardly any people, not very many people are aware of. I think more and more people are becoming aware of just how much of a scale this is. But to wrap it up within the next 30 seconds, if you look at RE 100, 100 plus organizations, about 300 plus organizations that have committed to renewable energy or procuring renewable energy. It's amazing. It's great. I encourage many other companies to be able to provide those type of commitments. But if you look at the attribution analysis of where these they're actually claiming this renewable energy is coming from, about 40% or so is roughly coming from renewable energy credits. These are credits that are relatively cheap, buying it for a couple of dollars per megawatt hour. Well, you might be actually utilizing some type of Midwest coal plant in the middle of winter, in the middle of night, using some type of Arizona-based type of credit, completely different grid system, not even connected at all, completely different time of the year, time of the day, And then all of a sudden, via carbon accounting, you're able to cancel it out, and then your scope, CO2 emissions go away. You can pat yourself on the back all night long, but does it really change anything at the end of the day for the real economy? And the answer is unfortunately largely not. Maybe perhaps on the very, very margin of having developers incentivized to build more, but it's not to the degree that was actually envisioned when these credits were developed.
I just want to stay with you for a second, Travis, because we live in this interesting world where there's a dichotomy. There's an attack on ESG. I mean, I think BlackRock's a great example. They're being attacked on the ESG front, and they're being attacked for not divesting from the left. So they're kind of getting squeezed from both sides. And it's become this, hot political debate. And yet, if we look at what's happening on the ground, and we wrote about this really 4 years ago, we said insurance companies would be the canary in the coal mine. And we're seeing over the last 18 months, 15 insurance companies leave the state of Florida, Louisiana, same type of run. And now in California, you've seen both Allstate and State Farm pull out from writing new homeowners policies. Do you see that as we see that as kind of a domino effect? Being in California, do you see that risk and how that might play out across real estate prices, mortgages, municipal bonds, and what the outcome of all this might be?
Yeah, so there's a couple of questions or topics there. One, we do see what's going on both in both segments or sides, left, right. We are in California, so we are insulated from some of this, but at the same time, we're also in the US. And so, Congress still definitely has insights and views into our actions and other asset owners' actions as well. So we definitely feel this. I think at the end of the day, what will be the trend is that you need to be kind of focused, putting your head down, specifically on investments, specifically on returns, specifically on long-term returns, and satisfying the mission of your members while not being distracted by those on one side that are talking about divestment, those on another side that are questioning you being able to even incorporate ESG, whatever their view of ESG is. You ask 100 people, you'll get 100 different answers. But and instead for us, as well as other asset owners, to just be laser focused on investment returns. Because if you can defend whatever you're doing based upon the investment returns, whatever, then I think that's the biggest defense mechanism that anyone can actually have. Now, if you actually do struggle to be able to articulate how whatever capital allocation that you're doing not just provide some type of social impact, but actually provide some type of economic, financial impact to your portfolio, then you're probably going to be in a very difficult position. And I would assume that this criticism will only increase over the next coming years. And I would say that investors need to make sure that they are choosing very wisely, not only for today's type of views, but also for tomorrow's views, to be able to defend yourself and your actions. And it's also why I think more and more investors over time will be focused on not necessarily optimizing their portfolios for emissions reductions, but instead optimizing their portfolio for investment returns, which, there's an argument from a fiduciary standpoint that they should have always been doing that, but then also doing so in a way which pursues climate solutions to be able to actually drive, drive real world type of returns.
Thanks, Travis. Kathleen, back to you. Well, God liked your comment, Travis, apparently. Going back to kind of standardized climate-related data reporting, we talked a lot about ESG today, and the prior panel made the point that we, have also been stating for a long time that ESG data is not necessarily climate data, and it's certainly not climate risk data in a lot of cases. It's really two completely different data sets. One's outward looking in, and one is inward looking out, looking for climate data of how a company you're investing in is maybe impacting the climate, but also climate risk itself, whether it's physical risk or transition risk, is not really covered in ESG data either. And I know you said what would really go a long way here would be more standardized climate-related data reporting. Do you think ISSB has covered any of that, or do you think there's still a big need to go further on that front?
On the data front, I would say it is the right start, but I think what we're starting to think about now is climate risk measurement with our risk team. So our sustainable investing team is doing the carbon footprinting, the kind of 101 of carbon accounting. But the next level is to actually tie that to the overall investment risk function, and not even just investment risk, but our enterprise and emerging risks. So broad the whole risk function of our organization. And that team is now trying to think through what are the other dimensions of risk, not only specific climate risk, whether it's transition, physical, what are the ways we're measuring that both bottom up, which is what we've been focused on, but also top down, starting to do climate scenario work, trying to understand what that really means, given the state of those models today, but also trying to understand the interconnectedness of those climate risks with actual risks that they're measuring, liquidity, market reputation, all those other pieces, and how they fit together. That's a much more complex activity. It gets into model governance, all these other things that the sustainable investing team does not do, but that the risk team does and are experts at. So it's really trying to marry the skills and expertise across these functions to try to move the needle on really understanding the risk exposure to the fund and the long-term funded status of the plan through this dimension. And that's not easy, and it's still early days.
And when you say that, because we have been wrestling this for years in our portfolio modeling, are you talking about both transition risk and a green transition and physical risk? Are you looking for data sets on both of those fronts?
On both, and the climate scenario work we've been doing combines them, but we're not convinced that's the right way to look at it, right? Depending on when we have a very customized portfolio. I talked about the focus on private assets, which are concentrated. So the region and sector and actual company activities play such a large part rather than general market indices, which a lot of these models are predicated on. So really trying to have more customized views of the dimensions of those risks beyond physical transition, all the pieces within, both separate and together. We're not quite sure if that works, but trying to explore all of these measures.
If anyone hasn't seen, I'll jump right to you, Paul, in 1 second. If anyone hasn't seen Risk Analytics AI, created by Ron Dembo, who actually created Algorithmics back in the day, which was a great risk tool. And it is available starting in July for free through Bloomberg. So this is not a sales pitch for Ron, but it's the best physical risk measurement, forward-looking measurement tool that we've seen. Paul, I was going to jump to you on this question anyway, and so you can respond to Kathleen, as well as kind of go into this climate transition, being in this deglobalized world that we're in all of a sudden. I mean, even if you go back to nuclear and we need uranium, and Russia is, the leading place to get uranium. China owns most of the lithium, cobalt, nickel, manganese resources. How do you see this all playing out from a geopolitical standpoint in this transition?
Yeah, well, let me start with risk and really uncertainty, Jeff. I mean, I think following what Katharine was saying, I mean, there's a huge range of uncertainty just in your 10, 20-year expected return on public equity, right? Could be 2 or 3%, it could be 12 or 15. We've had 10-year periods giving us both. And the climate transition, at least we have 100, 150 years of public equity data to sort of explore those possibilities. We haven't had a climate energy transition yet. Right. And then you throw in these geopolitical uncertainties. And so it really is a case where, getting back to leaving the herd, I mean, you have to have some strong convictions about what energy sources are going to replace fossil fuels. You have to have some fairly strong convictions about how policy is going to moderate that transition. You have to have some fairly strong convictions about how the US-China rivalry will play out. It goes beyond saying it's not easy to being hugely complex. And I think the industry is trying to be a little bit too facile at times about saying, oh, we're going to just reduce carbon in the portfolio. And that will solve all the world's problems. And the path to net zero does not mean a monotonically declining oil price, right? Who knows what happens to oil price? That's where supply goes versus demand. What kind of war might pop up involving a major oil producer or consumer. So I think if you're a long run asset allocator and you really want to wrestle with these problems, you have to write down what you think is going to happen. You have to have the courage of some convictions. You have to put your chips on the table. In other words, allocate a meaningful amount of money based on those views. And then you have to be willing to keep score in 5 or 10 years and go back to your stakeholders, go back to your beneficiaries, and take your lumps or your plaudits based on how it worked out. It's really hard. It is really hard.
It's amazing, and then we'll open for questions, but it's amazing how much money flooded into AI on just the ChatGPT blog post, basically. And you saw billions of dollars run from SaaS, VC funds and private equity over to AI in a heartbeat, and yet climate is still finding it difficult to get the huge amount of funding that it needs. And just going back, last point from my side, the $1 trillion+ that the US is going to invest in, there are some interesting charts that are out that this investment dwarfs any prior governmental funding of any project, going all the way back. The charts I saw went all the way back to the Great Wall of China, and these investments of governments, whether it was the space shuttle or World War II on defense or the internet, were all little tiny blips on a graph chart versus the funding that is going into a green transition. And we say to clients all the time, I don't care what side of the climate debate you're on, you can't look away from $1 trillion flow of money going into an investment thesis and not want to participate in that. That would be investment suicide in our minds. So far, great panel. I want to make sure we get to questions, and we're hiding from the bar. We're keeping everyone from the bar. So I will open it for questions.
When you're talking about making this transition and looking back and trying to find models for the energy transition, I don't know if there were records, but we did go from a sort of slight pre-industrial horse and buggy age to combustion engine. Do we have any records from the econometric records from that period to be able to perhaps look at that, because that was essentially an energy transition from whale oil to fossil fuels?
Well, and we have transitioned in a big way from coal to oil as well.
Well, those are transitions within fossil fuel to different fossil fuels. But so we've had some of those. Do we know what those look like in terms of what they do in terms of disrupting the economy, what they do in terms of what happens with policy and changes that were made to benefit, say, oil over coal, to benefit, well, sort of thinking out loud.
I'll open this to the panel, but we look at all historical transitions, and the horse and buggy is relegated to Central Park at this point versus the automobile, so not a good sign for fossil fuel companies. But does anyone on the panel want to touch their view on historical transitions that might give us some insight into the current transition that we are going through?
Well, just remember when we were replacing horses with wheeled vehicles, there were cars powered by steam. There was an electric car industry back early in the 20th century. So how would you have known that the internal combustion engine was going to be the winner? So there's huge. It's not nearly as deterministic as it looks now. We still face huge uncertainty about what industries or what technologies are going to replace fossil fuels, and it's not going to be based on cost. It's going to have to be based on government policy. It's not magically going to happen.
Yeah, the only other thing I would add is that I do have a slide on this in our July offsite. That'll be available publicly online in a couple of weeks. But it addresses information that was shared, I think, by Vaclav Smil, the author that's done many different type of climate energy type of books. But he has a nice data on this that tracks coal, natural gas, different variations. But the end of the message is that these are multi-decade transitions. And largely, even with those type of transitions, you typically don't see any one source taking up 50+%. There will be a mix of different solutions. We've already talked about 3 or 4 different types of solutions, just today, nuclear being one of them. I think it's would be insane to not believe that that's going to be part of the mix in a very relevant and material type of way going forward. Likewise, renewables. Likewise, if you don't even consider batteries as renewables, some people don't, then that will also be part of a mix. There's going to be a significant time frame where this evolution will take place, but it's not going to be happening overnight. And I think to Paul's point earlier, investors are going to have to be able to have some type of house views on these and some type of realistic data-driven type of views on whether or not they want to significantly allocate capital to and place all their bets into one, or understand that it's most likely going to be a transition across a variety of different technologies, a variety of different generation type of sources over not 10 years, 20, 30, 40 years.
Next question. Oh, Kathleen, you want to? Katharine, sorry.
That's okay. Just provide one other dimension we haven't talked about. We talk a lot about investment, technology, regulation, but also the demand side of the equation and the role consumers will play. And as a parent of young kids, their voices are loud and clear about their expectations about what they want to do, how they want to live, where they'll work, that there'll be drivers coming from the ground up that we may not be anticipating will be as strong as they are, that will help shift things along as well.
Next question. Yes.
With the New York pension fund being sued by divesting from fossil fuel companies, how is that changing your perspective on divestment and ESG investing in general?
Probably Travis, you're best positioned to answer that.
I'll try to be short.
Yeah, the question was with the New York pension being sued by people against divestment, where does that affect your views on the future of divestment?
Yeah, so there was SB 252 just in California that was going to be affecting both CalPERS and CalSTRS. Politico, I believe, just released an article yesterday citing that the chair of one of the committees that has discretion of whether or not this is going to go to an ultimate vote in the state assembly, will potentially be holding this. So this is the second year in a row that California pension systems, the 2 largest pension systems, have been facing divestment. It looks like it'll be on hold. Perhaps it'll be back next year. We will see. I'm sure there'll be plenty of conversations between pension staff as well as the state legislature. But regardless of what happens, for that bill, the staff, the organization has been adamantly against divestment. And, we don't think that this is effective effective mechanism. We find that it doesn't actually serve any type of real impact into driving emissions lower across the economy. We also don't find that it's the best way just from an asset allocation or diversification type of perspective as well. That's one aspect. And then the point that I also made earlier in the discussion is these type of things as they play out both from both sides, this divestment, this anti-ESG, it also always goes back into, at the core, we have to be laser focus on providing investment returns. And so you're going to, including CalPERS, we're going to need to kind of defend this and make sure that our actions are defendable as well from this these multiple different stakeholders that have different and competing type of views.
We have time for one more question. Who wants to be our lucky winner? Yes, Bill.
So we've talked about big transitions in the energy systems, big percentage changes. And in the course of financial history, there have been eras of what's a good portfolio. For example, starting in the 60s, equities were introduced, and we've had a period of financial assets here for the better part of 40 years. How do the responsible asset owners think about, will there be a big change in the way I structure a portfolio? Maybe I'll have 60% real assets will be the benchmark in 40 years, as opposed to 10% real assets versus financial assets. How do the panel think about the need to even change the way you conceive of a portfolio construction and allocation in this future era?
And also, I'd just like to add to that, there's a conflict a lot of times between a good climate, opportunistic, alpha-based investment and ESG. So maybe you can add in possibly how you balance those opposing themes sometimes. Anyone want to go first, Katharine?
I would just jump in on the comment. I heard a fellow Canadian pension plan colleague talk about the 60-40 of the future could be 60 mitigation, 40% adaptation, and that the whole classification of the portfolio falls across those dimensions, across asset classes. So getting out of the silos of asset classes and looking at it through a different lens. So I'll just throw that out there as an idea.
Yeah.
And also the big challenge in that question is breaking free of basically the backward-looking paradigm that dominates investing and asset allocation. We all look at the historical performance of indices of different asset classes, and we use that to build our portfolios when we know the future will be very, very different. One big difference is that fossil fuel production hasn't paid the cost of the externality it's imposed on the economy. So you have a material inflation of backward-looking returns to investment caused by the fact that the cost of those externalities are not included in financial benchmark returns. And so I think if you look at some of those past paradigm shifts, there were some investors that left the herd and made very major portfolio changes and caught and delivered fabulous returns in making those shifts. Of course, we don't hear about the folks that did that and failed. There were probably a few of them as well. But you can either you've got to differ from the herd to really succeed here.
Travis, last words, and then everyone will open the bar.
Sure.
Except for us.
Yeah. We'll send virtual drinks.
Okay.
There we go. The conversations I'm having with the different asset owners is becoming more and more likely that within these next type of strategic asset allocation decisions, that their capital market assumptions are going to be embedding, including integrating climate modeling within them. That goes for CalPERS, it goes for other pension systems that we spoke with as well. There's different vendors out there, I won't name them, that will help provide some type of data and influence some of the capital market assumptions on this. But nonetheless, I think it's safe to assume that there's going to be some type of noise, and these type of models will hopefully perhaps get improved over time. But at least it's a starting point to be able to start to incorporate this into some of the most important decisions. I would say the most important decision that any type of asset owner does, which is ultimately the strategic asset allocation.
Awesome. I want to thank my panel virtually. Virtual hugs. Thank you, everyone.
Thanks.
Thanks, guys.
Have a
Thank you.
drink for us.